The United States and China are locked in a trade war. Both countries have imposed tariffs on each other's goods. These tariffs are taxes on imports. The goal of tariffs is to protect domestic industries. However, tariffs can also lead to higher prices for consumers. In recent weeks, the trade war has escalated. The United States has imposed tariffs on $250 billion worth of Chinese goods. China has retaliated with tariffs on $110 billion worth of U.S. goods. The latest round of tariffs has disrupted global supply chains. Companies are scrambling to adjust to the new reality. The trade war is having a significant impact on the shipping industry. Shipments between the United States and China have slowed to a crawl. Some companies have halted shipments altogether. This is due to the high cost of tariffs. The tariffs make it more expensive to import goods from China. The escalating trade war between the United States and China has introduced complexity and cost to the global supply chain. Tariffs, taxes on imported goods, have been levied by both countries in a tit-for-tat battle. Businesses grapple with increased expenses, reconsider sourcing strategies, and explore alternatives. Consumers feel the pinch as costs are passed down the supply chain. The trade war underscores the importance of open markets and international cooperation. The trade war's impact on the automotive industry is particularly stark. Ford Motor Company, an iconic American automaker, has been forced to halt exports of several popular vehicle models to China due to the escalating tariffs. This move highlights the challenges faced by multinational corporations operating in an environment of heightened trade tensions. Specifically, Ford has suspended shipments of its F-150 Raptor, Mustang, Bronco, and Lincoln Navigator models from its U.S. factories to China. These vehicles, once symbols of American manufacturing prowess, have become entangled in the web of tariffs, making them prohibitively expensive for Chinese consumers. The decision to halt exports to China represents a significant setback for Ford's global growth strategy. China, the world's largest auto market, has been a key driver of Ford's sales in recent years. The trade war threatens to undermine Ford's progress in this crucial market. The impact of the export halt extends beyond Ford's bottom line. It also has implications for the thousands of workers employed at Ford's U.S. factories that produce these vehicles. The reduced demand from China could lead to production cuts, layoffs, and economic hardship for American workers. Gateway to gridlock Hong Kong shipping crisis. The trade war's impact is not limited to the movement of goods between the United States and mainland China. Hong Kong, a special administrative region of China and a major global shipping hub, has also been caught in the crossfire. The escalating trade tensions have created a shipping crisis in Hong Kong as businesses navigate new tariffs and logistical challenges. The U.S. government's decision to treat Hong Kong as part of mainland China for trade purposes has had significant ramifications for businesses operating in the region. The imposition of tariffs on goods originating from Hong Kong has disrupted established trade flows and created uncertainty for businesses. One of the most visible consequences of the trade war on Hong Kong's shipping industry is the pileup of containers at the Kwai Chung Container Terminal, one of the busiest ports in the world. The reduced demand for goods from the U.S. due to tariffs has led to a backlog of containers, creating congestion and delays in the shipping process. The shipping crisis in Hong Kong highlights the interconnectedness of the global trade system. Disruptions in one part of the world can quickly cascade and have far-reaching consequences. The situation in Hong Kong serves as a stark reminder of the potential economic fallout from prolonged trade disputes. Sunny skies to storm clouds, Los Angeles. Port braces for impact. The Port of Los Angeles, the busiest container port in the United States, is bracing for the impact of the trade war. The port, which handles a significant portion of trade between the U.S. and China, is already experiencing a slowdown in cargo volume as businesses adjust to the new tariffs and trade uncertainties. The initial surge in imports at the Port of Los Angeles, as businesses rushed to bring in goods before tariffs took effect, has given way to a more subdued outlook. The port is now projecting a decline in cargo volume as the full impact of the trade war is felt. The slowdown in trade at the Port of Los Angeles has implications for the broader U.S. economy. The port is a major gateway for goods entering the country, and a decline in cargo volume could signal a weakening of economic activity. The trade war is creating uncertainty and volatility in the global shipping industry. Businesses are facing difficult decisions about how to adjust to the new reality of tariffs and trade barriers. The situation at the Port of Los Angeles underscores the potential economic consequences of prolonged trade disputes. Navigating the maelstrom corporate America responds. In response to the turmoil unleashed by the U.S.-China trade war, American companies are grappling with the fallout and strategizing to mitigate the impact on their operations. The tariffs have introduced a new level of complexity and uncertainty, forcing businesses to reevaluate their supply chains, pricing strategies, and investment plans. One of the most common responses to the tariffs has been for companies to absorb the increased costs of imported goods. This strategy, while protecting consumers from immediate price hikes, is unsustainable in the long run and could erode profit margins, potentially leading to hiring freezes, reduced capital investment, and a slowdown in economic growth. Other companies have opted to pass on the increased costs to consumers in the form of higher prices. This approach, while potentially offsetting the impact of tariffs, carries the risk of dampening consumer demand, particularly for non-essential goods. This could lead to a decline in sales and ultimately harm the businesses the tariffs were intended to protect. Some companies are exploring alternative sourcing options, shifting production away from China to countries with more favorable trade agreements. This diversification of supply chains, while potentially reducing reliance on Chinese imports, can be costly and time-consuming, requiring significant upfront investment and potentially disrupting existing relationships with suppliers. An uncertain future, the road ahead. The U.S.-China trade war has cast a long shadow over the global economy, injecting uncertainty and volatility into international trade. The tariffs, intended to protect domestic industries, have instead created a complex web of unintended consequences, disrupting supply chains, driving up prices, and threatening economic growth. The path forward remains unclear, as both sides dig in their heels, seemingly unwilling to back down. Negotiations have stalled, and the rhetoric remains heated, leaving businesses and consumers alike to grapple with the fallout of this trade war. The trade war underscores the interconnectedness of the global economy, highlighting the risks and challenges of protectionist policies in an increasingly integrated world. The tariffs, rather than achieving their intended goals, have served as a stark reminder of the importance of open markets, international cooperation, and predictable trade policies in fostering global economic prosperity. The road ahead remains uncertain, and the ultimate impact of the U.S.-China trade war is yet to be fully realized. However, one thing is clear: the tariffs have created a lose-lose situation, harming businesses and consumers on both sides of the Pacific. The longer the trade war drags on, the more damaging the consequences will be, potentially leading to a global economic slowdown.